Hello everyone, my name's Holly Mackay and I'm Managing Director of the Platforum. I want to take this opportunity as we wind down for the festive season to take a look back at the year 2011 that was and have an assessment of the platform market, what happened and what can we expect to see moving forward next year. It's been a pretty busy year, it's been a pretty busy week in our household. I don't know about you, but getting ready for Christmas, the boiler's broken, the roof was leaking. We even lost baby Jesus yesterday, but we found him under the coffee table this morning next to Harold the helicopter, so calm was restored. Not been so calm really this year in the platform market, with a lot of change, a lot of activity. 6 things really I want to talk about is the new platforms coming to market this year. I want to talk secondly about regulation, the impact that's having on pricing, and then third about fees more generally with platforms. I'd like to talk to you about the changes to the value chain and different things that people are doing along the way. I want to talk about different channels. We've seen a rise in the D2C market, lots of chat about execution-only platforms, lots of discussion about corporate platforms. And finally, I want to end up just having a little look to the future, what we can expect to see in 2012. Let's see the new platforms, who's come to market. Well, Aegon. A very interesting sort of announcement in the year about partnering up with Novia to bring a retirement-focused platform to the market, so we'll hear more about them next year. Andy Bell and the team launched the SIP Centre platform by adding GIA and ISA capability to the SIP platform they have and we already know so well. Zurich have postponed their launch to next year, but another life company to come into the market. Those are the 3 sort of big announcements we've had this year. I do think we'll see a bit of a slowdown in new players coming to the market in the advisor platform space next year. 28 platforms and it's getting quite busy. We also saw this year the policy statement from the FSA about platform regulation, and there was a lack of detail in there which I think disappointed everyone. There's still an awful lot of questions. The analogy I have going through my mind this week is Hamish's nursery still hadn't told me by last week whether he was going to be an elf, a reindeer or an angel, and I was panicking. They only gave me a week to make the costume. Turns out I made an elf costume and he wants to be a reindeer. It's tomorrow. Guess what I'm doing tonight? Now the FSA haven't given people enough time, but one thing I think they have done is set out the lie of the land enough that the 3 big supermarkets, Fidelity, Cofunds and Scandia, have all come out and said they will have unbundled pricing models. I think the other thing the FSA have done this year is been much clearer than they have been before with IFAs about the platform due diligence they expect to see them do, and the burden of proof kind of more than ever is firmly on the shoulders of the IFAs. You have to justify the platform or platforms you've picked for a client, and client suitability are the 2 words that are really important at the heart of all of that. I think on the fees point, what I would say is we're seeing continued pressure, downwards pressure on fees. To start the year off in January, Transact came out and cut the top tier of their fees to 55 bits. They also committed to cutting that to 50 basis points from January 2012. Fidelity also made an aggressive pricing move in the middle of the year, and generally I think we'll continue to see the downward pressure on pricing that we've seen. I mentioned earlier changes to the value chain. I think for me one of the biggest news stories of the year was Citi acquiring Scottish Friendly's wrap admin business. This is really interesting. The big boys are riding into town, and I think it's a scale game and people are assessing more and more, can we compete as this market gets bigger and bigger? And we've had some news stories out recently which show how difficult it is to run wrap administration and how expensive if you get it wrong. So I think we'll see some bigger global names come in at that transaction custody and execution end of the market and perhaps take over from some of the smaller players there. So changes there to the value chain. I think also one of the most interesting stories of the year for me was AXA coming out and saying if you use the Elevate platform and you buy Architas funds, we won't levy a platform charge there. And you start to think to the future and what that might mean, and are people going to charge for platforms? Or where they've got something to cross-sell, do platforms become a profit centre, somewhere you look to make a bit of money in its own right, or do they become a cost centre and something you have to sell other vehicles? I think we'll hear more debate about this over the coming 12 months. Different channels. We're currently finalising our research for our next D2C platform, and they've been all over the news this year. Barclays doing something interesting with Project Lancelot, very sort of macho name there, launching a platform direct clients to who want to buy investments or mutual funds in an ISA. Charles Stanley have come out and said that they're building a direct-to-client offer. Money Supermarket, of course, at the beginning of the year came out and announced a tie-up with co-funds. We estimate, as at September last year, the D2C market was about 75 billion, so growing steadily given the investment climate that we're working in. Also, corporate platforms. We've published Buy One While Stocks Last. Well, actually it's free. It's available free of charge on our website. And we're looking at this emerging market, which we think is going to keep growing and is a really interesting area for future focus. So do download that off our website and have a look. Finally, as we look to the future and see, well, what's going to be happening more, what are we going to see in 2012? Discretionary platforms, discretionary fund management, model portfolios, that idea of a centralised investment process has been a trend we've seen develop each quarter, and more advisors are saying, I'm not fund picking. So we think we'll hear a lot more about that over the coming 12 months. Regulation, we will have to hear greater clarity from the FSA on issues such as the cash or unit rebate questions in the run-up to RDR 12 months and counting. A final trend I think we will see a lot more of is distributors, big distributors saying, I'm not sure I want an off-the-shelf platform. I think I might want some sort of an institutional platform. We talked about the big boys earlier, to plug in that transaction custody and execution piece. But I want to build the website and I want to keep a bit more control. So I'm not looking for an off-the-shelf platform. So different models emerging. I think in turn we'll see a shake-up in the advisor software market. I think given the developments in technology we're seeing elsewhere, some of it's beginning to look a bit dated and there are some interesting plans on the horizon. So that's it from us. Thank you very, very much to everyone for your support throughout 2011. Have a wonderful, wonderful, wonderful Christmas, a great break, and we'll be back in 2012 for what promises to be a rather dull and uneventful year for us all. Over and out.